Hi, this is James Shug in Westpac's London office with the Global Economics Wrap, prepared on Thursday, June the 26th. Well, in Australia over the past week it was pretty quiet. There's not much to report on the economic data front, but it's going to be a much busier week next week. The Reserve Bank Board meets on Tuesday. We're not expecting any change in interest rates. Our view is that the RBA will be on hold until well into next year, with the first rate rise of the next upcycle not coming through until the second half of 2015. We also get quite a bit of partial economic data, credit figures, trade figures, building approvals and retail sales as some of the data which will add to our understanding of where the Australian economy is at the moment. I mean, there's been a bit of softness in some of those indicators in the housing sector, retailing for example. Even the latest jobs numbers are a bit softer. So it'll be interesting to get an update on at least some of those sectors next week to further our understanding of how the economy is tracking. Internationally, there's been a bit more to talk about. In China, we released the Westpac MNI Chinese Consumer Sentiment Index, just the second release of that for June. It fell very sharply, more than reversing May's rise and actually resuming the downtrend that started at the start of this year. Chinese consumers are actually not feeling at all confident. In the 7-year history of the series, we've only been down around these levels on 2 occasions before, about a year ago briefly and also in late 2011. Some of the components of the index, including the labour market outlook, are at levels now that are consistent with the PBOC, the People's Bank of China, putting in place policy easing. And in fact, that's our view for the third quarter. We'll see a reduction, we think, in the reserve ratio from the PBOC. Some of the other data on China, for example, the flash estimate of the HSBC's PMI for June, were less weak. We kind of reconcile that by saying that the consumers in China aren't feeling the sorts of export pickup and inventory rundown factors that are helping support the business surveys. That just doesn't feed through to the household sector, and it's the domestic economy that's increasingly important in China, and that's what the PBOC are likely to respond to. Coming up next week in China, we've got the remaining swathe of June PMI surveys, not just for the factory sector but for the services sector as well. So there's a bit more Chinese data to watch over the next week. In the United States, the highlight, I suppose, past week was the revision to the first quarter GDP numbers. Minus 2.9% annualised is the new number for the first quarter. It was originally reported at flat. In the first revision, minus 1%, now almost minus 3%. Now this comes just a week after the Federal Reserve published its latest projections for the US economy. They cut their forecast for 2014 from 2.9% to 2.2% growth. That's through the year to December. But for them to be able to achieve that, given the weaker starting point that we now know about, they're going to have to see growth of 4% annualised in the second quarter, third quarter and the fourth quarter. And that's something the US economy hasn't delivered at all in the past decade. And given the headwinds confronting the economy, fiscal headwinds are abating, but the household sector is still pretty constrained in terms of incomes growth, in terms of ability to get mortgages because of poorer credit that younger people have these days in the States. Those sorts of factors we think will make it very unlikely that we'll see that sort of growth outcome achieved. So the Fed will probably have to revise down yet again their forecast for the US economy just a week after their last revisions. Some of the data we had on orders and on spending for May was pretty soft as well. So the early indications that we're getting for the second quarter are that the bouncing growth is not going to be that spectacular. Again, indicating that it's going to be tough for the US to deliver on the forecast that the Fed published just last week. For the record, our forecast is 1.4% through the year growth to December, compared to 2.2% that the Fed currently is operating on. US data next week, the highlight will be the payrolls figures, the monthly jobs report. Jobs growth has been pretty spectacular in the US so far this year. We think too strong, in fact, given the sharp slump in the economy in the first quarter. So we haven't finalised our forecast quite yet, but certainly we're looking for either a downward revision to recent numbers for April and May, or a weaker June outcome. Those figures come out on Thursday, normally Friday, but it's the Independence Day holiday next Friday, so the jobs numbers in the US will be out a day earlier than usual. In the UK, the Bank of England governor announced new measures designed to curb some of the excess in the housing market. We had expected this. The stress testing of new borrowers is going to be tightened up, made a little bit tougher. They're going to, that is the interest rate that will be imposed upon the borrowing ability of new borrowers will be 3 percentage points higher than the current rate. So to see that borrowers will be able to cope with rates rising. That's tougher than the previous stress test. Another measure was imposing a 15% limit on banks being able to lend for mortgages with greater than 4.5 times loan size relative to income. That hasn't actually been exceeded recently, but the bank is basically putting a 15% cap on the ability of banks to make those sorts of loans. And the Treasury also tightened up its Help to Buy scheme, whereby the government guarantees part of the deposit for new borrowers. So some measures there designed to slow down the housing market a little bit, which actually takes some of the pressure off the interest rate side of things. And we remain of the view that the Bank of England won't be tightening interest rates until the first half of next year. In fact, Governor Carney made some comments this week emphasising that low. He too seems to be backing away a little bit from this notion that rates might be rising before the end of this year in the UK. And in Europe, well, we saw the latest round of purchasing managers indices or business surveys for June. They were disappointing. They also showed the French economy in particular looking pretty ordinary. One of the problems in France is that they haven't put in place the sort of competitiveness improvements that they need to, and in the sluggish growth environment that Europe's got, it's really exposing some of the weaknesses in the French economy. And next week we get the European Central Bank's July meeting. Now, given they put in place policy easing in June, it's unlikely we're going to see anything new as soon as the July meeting. We do expect the ECB to put in place an asset purchase program, probably early next year. But for the time being, it looks like Draghi can just sit on his hands, having done quite a bit in June. That's about it, other than to note that the increasing tensions in Ukraine and also the descent into chaos and anarchy in Iraq certainly impacting on markets over here in Europe, stock markets, but no real economic impact on the real economy just yet. But they're factors to watch as well. Okay, I'll look forward to speaking to you again next week.